All right. The countdown has begun. Hey there, I'm Mitch Goldberg. Welcome. I appreciate you joining me. I appreciate it so much. This is my live stream. Be the boss of your money. We talk about personal finance, investing, so much about the economy, the stock market, asset management, the things that you need to know. The idea is to give you the tools, the knowledge to help you be better with your money, to help you take control of your money, to ultimately prevent you from making bad decisions. Like we're in a did I say Rocky Martin? Like we're in a rocky market and people are selling their stocks and they're buying their stocks or going to cash because shouldn't I go to cash and shouldn't I buy everything back? And people are just making a lot of really bad moves or they're nervous about it. They're constantly thinking about what their next move should be with money. And it's not just about the stock market. It's what about your next move with how you borrow, how you lock in a low rate for your house. Hopefully, you did refinance when mortgage rates were really, really low. I'm sure you did. But we talk about personal finance here, and it's about taking control of your money. That's why I came up with the corny name, Be the Boss of Your Money, because I wanted something that said money boss or whatever. And I'm kind of stuck with it, and I don't want to change it. But we're going to talk about a couple of things today. All right. First, we have a busy week. Google, Microsoft, Apple, and Amazon all report earnings this week. We've got a Fed meeting on Wednesday. It's expected that the Federal Reserve will raise interest rates 75 basis points or 0.75%. That's a big deal. And what else? We have GDP on Thursday. We've got a couple of other things to look at, and I want to take a quick look at Walmart stock is getting crushed after market, Weber Grills, and Home Depot. And just to give you an idea of just how much the economy is slowing down, I've been saying for a while we're in a recession. The GDP figures on Thursday will confirm or deny that. But I think the economy is in a technical, mild recession right now. Does it get worse? Does it not? A lot of people have their opinions, but the best opinion I can give you is we'll see what happens because nobody's a fortune teller. And there will be somebody who says, I knew it would be a shallow recession. And the people see everything. And then if whatever scenario comes out, someone will say, oh, yeah, I said that. By the way, if you don't have a timestamp like a video recording or something in writing, don't tell me what you said because anybody could say anything. Show me an email. Show me something that you predicted what would happen. And then when it happens, you could show it to me. But don't just say, oh, I knew this would happen. I knew that would happen. Because without a timestamp, you're just basically, full of shit. And we don't have time for that nor patience on Be the Boss of Your Money. So let's roll the intro and we'll get into the show. If you have any questions, hit me up in the comments. If you have any words of wisdom, words of encouragement, I always appreciate that in the comments as well. If you could, please give us a like, give it a thumbs up, a heart, an applause, a wow, whatever reaction is available to you, depending on which social media platform you're watching on. It helps to spread the word about the good work we're doing here, about the knowledge we're sharing here. The show is sponsored entirely by me, so it's always a benefit and an appreciated thing when you do give us some social love. All right, here we go with the intro. All right, it's good to be with you today. I see a few people out there. One, I'd like to give a shout out. I see Amy out there. Nice to see you, Amy. It's I don't know if I've ever seen you out there. I think you've watched the show, but just know that if you don't give it a thumbs up, I can't see you. It's like, I can't see you, but if you give it a thumbs up, whatever, I'll see the name of the person. Usually, sometimes it'll just say like Facebook user or LinkedIn user. I'm broadcasting right now too. Excuse me. I'm broadcasting to LinkedIn, 2 Facebook pages, Twitter, and YouTube. So definitely follow me on any of those platforms. And if you're watching on YouTube, please give me a subscribe. Really would like to get those subscriber numbers up. And let's take a look at a couple of things, okay? First, we're going to look at what I think is the most important story of the day. And for some reason, we're not going to the fourth screen. All right, it doesn't matter. All right, we have this camera. We have that camera. All right, this is camera 2. Let's go back to camera 1. The first thing I want to point out is Weber Grills. That Weber Grills came out today and they said, supply chain issues, and they missed earnings and revenues, and the CEO left the company abruptly today. Stock took a big hit, but it's already been taking a big hit because it's so far below its year high, even before today. But the issue is that it's not just supply chain issues, it's that demand is slowing meaningfully for Weber Grills. During the pandemic, people rushed out and bought grills because they were staying at home, they're working from home, they couldn't go to restaurants, so they turned their backyards into an oasis. They bought the stuff like crazy, but Weber Grills like crazy. That has worn off. And then I look at the stock of Home Depot, and the year high in Home Depot is 420, and the stock now is aftermarket trading. It's at 300. It's down. It closed at 306. It's down almost $6 right now because of the Walmart news, and Walmart is down 10% right now in aftermarket trading. Can you believe that? Walmart is not the kind of stock that goes up or down 10% in a day, but it's down 10%. A lot of you may own Walmart and are thinking, I bought that as a solid stock to own in a recession, in a time of inflation, because they have buying power, you get the best prices, so people will go there to get the most money for their, the best bang for their buck. And Walmart is down a whopping 10% aftermarket trading. You put all of these together, the consumer is slowing down so fast. And this is why I say we're in a recession. And if you take a look at other stocks, consumer staple stocks, which are very, very high historically based on certain metrics like their P ratios, actually highest ever in history, you really have a lopsided market in terms of, well, first of all, the pandemic stocks have gotten crushed, but the stocks that you were relying on that you thought were safe, steady income earners like Walmart and Home Depot have just gotten absolutely smashed. So Walmart's down after today almost 20% on the year. Home Depot is down over 20%. Home Depot is down 26% of the year. Weber is just down a lot more. So these are the things that I look at. So I don't just look at the price of a stock and say, oh, wow, that stock went down. I want to look to see, is it isolated? Is it part of a group of stocks? For example, Walmart, Home Depot, Weber Grills. Yes, they're part of the consumer names, but they also were a part of the pandemic names because people were working from home, staying home, and these companies sold goods that allowed you to stay at home, like Walmart, and Home Depot, for example, selling fewer barbecues, which came out in the numbers of Weber Grills. And this just goes to show you that the consumer is slowing down meaningfully. It also shows you that demand is pulled forward. A lot of people bought homes, and that's kind of done for now. Home sales are practically non-existent all of a sudden. So that's what's going on there. All right, what is driving the stock market? I keep my notes here. What's driving the stock market? Performance anxiety. Okay, and okay. So finally, I could put my screen up. All right, so that helps. Let me see if I could do this. Pop myself up here. All right, so this is the stock of Walmart. This is today, and you see this drop here. This is aftermarket trading. Zippo right down 12%. Okay, you see that down 12%. Let me see if I can make this a little bit bigger. All right, you see that pronounced downtick, this whole downturn over here. right there. This is all today. And Weber Grills stock got crushed today. But let's take a look at Weber Grills year. If we could find the year to date, please. Stock was 12. Anyway, now it's 6. Okay. So that is that. And now let's take a look at how the overall markets are today. So the Dow up 90 points, not a terrible day. Nothing major, up or down, up a little. The Nasdaq was down a little. The S&P was up a little. Gold was off, continuing to stay in the 1700s. Looks like gold wants to hit the 1600s. Oil was up $1.75, but it was down a lot last week. The 10-year yield continues to stay below 3%. The VIX at 23. That's a big story, guys. Watch the VIX. We see that going to 20. We've got ourselves a whole new leg up in the rally. Okay. Let's take a look at the bond market. Most important thing in the bond market is the spread between the 2-year yield, which is over 3, and the 10-year, which is 2.87. See this 3? This should be a 2, and this should be a 3. So that means the yield curve continues to be inverted. It's inverted long enough to say it's a sticky inversion, and that is a forebearer of tough economy to come. I think we know that. I think we've been talking about that for a long time. So what's driving the market right now is performance anxiety, performance chasing. Overwhelmingly, fund managers. Okay, I'm not talking mom and pop investors. I'm talking people who are actually managing money for a living. Went so heavy into cash, so heavy on pessimism. And they were right for a little while. The market went down a lot. So cash is king. Cash held up. So the market went down. So that good for you. Good for portfolio returns. But what happens now is as soon as the stock market started to go up a little bit, and the feeling started to come around that, well, if we are in a recession, the Federal Reserve might actually be getting done, might be close to the end of its rate tightening policy. If that happens, stocks start to go up a little bit. And then sure enough, stocks did start to go up a little bit. The last couple of weeks, stocks have been moving up. And then what happens is, if you're in cash and your portfolio is down like 20%, and the market's down 25%, you're looking good. But all of a sudden now the market's down 16 or 15%, and you locked in losses and you're down 20% and you're sitting on that cash. You don't want to lag the market so much. So what do? You start taking your cash and you start investing it into the stock market. And you're not buying any old stock. You're not buying, what we ordinarily would consider blue chips. You're buying beta, meaning you're buying beaten down, lower quality stocks, because these are the stocks that can go up the most when the market has a rebound. And that's exactly what's happening. So money managers and professional investors all of a sudden realize that they're lagging their benchmarks by so much, by such weak performance, because it's are so heavy into cash, that they're forced now to buy stocks to make up for lost time. They're literally buying stocks indiscriminately because they need to get money back into the market, because now the market's taking off without them. Now, that could be a problem for them if the market backs up again. Then they'll say, why did I do that? But that's what drove the market, really. Yes, there's a sense that the Federal Reserve might be done with rates. Think of the Federal Reserve raising rates like this. Usually the Federal Reserve, this is the chairman of the Federal Reserve, Jerome Powell, and he gets together with a few other bankers who were heads of the Federal Reserve bank branches around the country. And not all of them, but a few of them get together with the Federal Reserve chairman, and they decide if they should lower or raise short-term rates and by how much. And when they lower or raise, they usually go by 0.25%, 0.25%. Recently, they did a 0.75% move, which is like 3 rate hikes in one, and they're expected to do a 0.75 again this week on Wednesday. So if you do that, that's 3, if that's 6, that's like 6 rate hikes that would ordinarily take almost a year to do in just 2 meetings. So they've really accelerated their pace of monetary tightening, of raising interest rates to slow demand, to slow the economy, to help lower inflation. But now the feeling is the Fed might do another 75 basis points and then wait, or slow down its pace of rate increases. That's very bullish for the stock market. It's very bullish for high beta stocks that trade on very high PE ratios or are losing money, because that means when interest rates stay lower, those stocks could be valued more based on discounting, their discount rates. Just believe me, it makes highly valued stocks do better when the Fed stops raising rates. And the Fed could even now, there's thinking in the street, on Wall Street, that the Fed could actually start cutting rates next week. So this is driving stocks higher. But when stocks go higher, money managers who are sitting on so much cash look at the market going up without them and say, I can't be in all this cash because the stock market's going up now and my portfolio is just sitting flat. I need to put cash into the market. And as money managers do that, the market goes up more. And then the next money manager has to do that. And then the next one, and so on and so on. And you just have a boatload of money going into the market. And that's really what's been happening the last couple of weeks. This is a very technical driven, very market mechanic driven market. The fundamentals of the economy haven't changed one iota in the last 3 or 4 weeks. Maybe it's gotten a little bit worse. But the mechanics of fund managers rushing to put money into the stock market, rushing to get invested, that's a big deal. And that's what's been driving stocks. So I just want you to know how this works. This is a little bit of inside baseball stuff, but that's pretty much it. So again, big week today. Tomorrow, Google and Microsoft earnings. Thursday, Apple and Amazon earnings. Thursday is GDP figures. Wednesday is the FOMC meeting for interest rates. We have, stay-at-home, work-from-home stocks like Weber Grills and Home Depot getting crushed. We have Walmart getting crushed because of inflation. It's hurting consumers. It's a really pessimistic view when you look at the economy, but it's starting to get rosy when you look at the stock market. And since the stock market is typically a foreteller of better times or worse times to come, the stock market is telling you a message that the Fed could be getting is probably near the end of its rate hike cycle. Inflation has peaked, which is a story we've been talking about a lot here. And overall, it's very bullish for the market. And even interest rates look like they have peaked and are staying lower, under 3% on the 10-year. That's my story. I'm sticking to it. I'm going to get going. Got a couple of things to do today. And hey, man, happy Monday. All right. Talk to you soon. Bye.